Hello friends, starting with third session of derivatives, and we are straight continuing with our last time's discussion. Last time we learned about the futures contract, and if you can recollect, this is the payoff of the buyer of the future. This is the payoff of the seller of the future. And what did I say? Something very important that you should recollect from previous session was the obligation. So in the futures, both buyer and seller are obliged. That means both are supposed to execute their position. So buyer has to buy and seller has to sell. Though on the stock exchange, they've got a separate mechanism to trade, but still, as per the contract, they both are obliged. So somebody sitting with the contract at the end of the contract period, then definitely they are obliged to perform their duties or obliged to perform their promise. Now today we are starting with options. Essentially, idea is to cover up call option. Usually, I do not teach call option and put option together. So we'll complete what is call option. What about options as such? Then we'll take the call option, payoff, moneyness, intrinsic value, time value. This is what I try to cover up today. Let's see. Okay, so let's start with options straight away. So like forwards and futures, options are derivative instruments that provide the opportunity to buy or sell an underlying asset on a future date. So this is definitely the basic essence of derivative. But now how options are different. And this is where most of the trouble starts for the student. The reason being call option, put option, when it is exercised, when not exercised, and when then eventually when we are going to start with strategies, that is what creates a lot of trouble to the students. Okay, an option is a derivative contract between buyer and a seller when one party, say the first, gives to the other the right but not the obligation to buy from the first party the underlying asset on or before a specific day at an agreed upon price. In return for granting the option, the party granting the option collects the payment, and that is known as premium. So sounds very, very confusing. And like on the face of it, like my experience is that most of the students who are studying derivatives for the first time do not understand this definition. So now let me take a simple example. Say for example, buyer and seller, they contract at a price of 100. Now if it's a futures, then if market price is more than 100, then buyer will make profit. If less than that, then buyer will lose. And opposite is the situation of seller, and both are obliged to perform their promise. Now here in this particular case, buyer asks for something specific, something special. What he says to the seller is, allow me to buy when the price is more than 100. But when it is less than 100, I will not buy from you. This is the proposal which has been offered or they say given by the buyer to the seller. True. So what has been asked? Buyer says that when price is more than 100, I'm going to buy, otherwise I will not buy. So this leads in something very interesting. Buyer will have profit or no profit. And seller in this particular case would have loss or no loss. Now you will never be finding out such a stupid seller who would agree to this particular arrangement. Then buyer's proposal is straight away rejected. Now something interesting has to come. Now move further. Buyer says, okay, why am I a buyer? Or why have I become a buyer? Because he's anticipating rise in price. Why somebody has become a seller? Because he's anticipating fall in price. Now, this is the basic proposition, basic idea. Now, buyer says, anyway, price is going to increase. Let me offer something which lures the seller. And say, for example, he offers 10 rupees upfront to the seller and says that this 10 rupees to be kept by you. Now accept my proposal. So that means buyer is asking what? When price is more than 100, he would buy. Otherwise, he will not buy. And for that, he's giving 10 rupees straight away to the seller. Now seller once again rethinks that why have I become a seller? Because I'm anticipating fall in price. So is the reason. He would say price won't increase. And I'm getting an opportunity to pocket 10 So this is the best opportunity. Let me pocket 10 and allow the buyer. So here the contract has been framed wherein buyer has paid 10 to the seller, and because seller has accepted something from the buyer, he's permitting buyer to buy from him when the price is more than 100. Now in this case, buyer has two interesting things to decide. So first is that whether he should buy or not to buy. So buyer has a choice. Buyer has the right. And how he has got the choice, how he has got the right? By paying something to the seller. Technically, this thing is known as premium, and this choice and right is better known as option. So do remember something at base, the one who pays the premium has the right, has the choice. And the one who collects the premium, seller doesn't have any option or right. Seller has only obligation. That means he's supposed to follow the action of the buyer. So this is how we can understand the definition of an option. So wherein one party granting another party the right but not the obligation to buy from him against something called premium. So that definition has been very well justified. Still, if you are not able to understand, you can definitely let me know. We'll figure out how I can make it further easier for you. Now, let us look at the payoff. What happens, like in monetary terms? Now, there is an interesting term that we have to learn. So we have a terminology section also that I'm going to cover up soon. But yes, once we complete all the types of options and most of the things, then we'll look at this terminology. But yes, as of now, I'm introducing only one term that is called exercise. Now, what is exercise? Exercise means, and yes, first of all, in India, options are exercised on the final day, that is on expiry day. Exercise means if I'm in the same option, the one that we understood is named as call option. The one that we understood is known as call option. So this arrangement entirely represented which option? Call option. Now, understand, exercise means on the final day, buyer will pay money to the seller and seller delivers the shares to the buyer. Right, so this is something very important, and of course there is lot size in everything that we cover up eventually. In futures also we do have a lot size that we have studied. In options also you do have a lot size, and if like time permits, on one of the working day I may record a session wherein I can capture the NSE screen. That will definitely help you understand more in terms of derivatives. So exercise means executing the contract. That means if I'm a buyer in the position, then I would be paying money to the seller and seller delivers me the shares, though it maintains anonymity. It is just for an example. So you can, that is what is called exercise. Now, say for example, let us evaluate a scenario. Now, price on expiry. So I'm writing different prices on expiry. So say for example, the price on expiry happens to be 90. Will this option be exercised? Answer is no, because buyer has paid premium to the seller, and this has said that when price is more than 100, I'm going to buy from you. So any cash flow from the option? No. Premium paid is minus 10. So net happens to be minus 10. So this is the net loss to the buyer. Now, another price we quickly take is 100. And as I said, 100 also no exercise, because as per the contract, when price is more than 100, no cash flow, minus 10 and minus 10. Do understand this methodology, this mathematics is not much important in CFP exam, but this is very important in CWM exam, level 2. Now, say when prices is 110, so this will certainly be exercised. Cash flow from the option is 10, minus 10, 0. This is called break-even point. So for a call option, break-even point is equal to strike price plus premium. That means you are supposed to collect the or recover the premium with increase in price. That's the rationale, that's the intuition. And post that, say it is 120, this will certainly be exercised. 20 is the cash flow, minus 10, and now you are having positive cash flows coming in, we can call it unlimited profit. But unlimited, there's nothing unlimited in this world, but it is simply substantial, but we generally use in finance books to be unlimited. And if I draw the payoff chart of this, then how would it look like? So say, for example, profit, loss, the way we have drawn for the futures. So where is my break even point? It is 110. So when the price is more than 110, it gives me profit unlimited. When it is exactly 100, I am at loss of 10, and then it remains static. So compared to futures, had it been futures, then it would have been a linear payoff to the buyer. But since this is an option, it results in non-linear payoff. Why? Because you have got a right, you've got a choice, you've got an option. This is how it goes. And exactly opposite situation will happen for the seller. Now, there is one more common mistake which students make. So this was for buyer. Okay. Now, let me write for the seller. Same strike price. So say price on expiry is equal to 90. Now, will this option be exercised? Will this option be exercised? Now, many of the time students says, yes, when price is less than 100, seller will exercise. But no, this is the call option. Who has paid the premium? Buyer has paid the premium. So he is the only one who has to decide whether to buy or not. Seller has obligation. He has to follow the action of the buyer. So he will not exercise, right? Buyer will not exercise. So this is to be looked at from whose angle? This exercise is always to be looked at from the buyer's angle, not from the seller's angle. So do not make this mistake. And this is what trouble the students when they mix up many things. We can say khichdi, and rest of the things go the same way. Cash flow, nothing. Premium for him is positive 10. So net is also plus 10. So this is how the entire table will be created. So where we have got plus will become minus, and similarly I'll draw the chart, payoff chart. So this says that the same break even point 110. So when prices are more than 110, buyer's profit means seller's loss, right? And then at 100 exactly there is profit of 10. So this is the payoff for the seller of the call option. So I'm just taking quick overview of it. So if you want further details, you can definitely let me know. Now, some of the things that we have to introduce. So first is strike price or reference price. That is the agreed upon price. In our example, that was 100. So 100 is the reference price based on which we were deciding whether to exercise or not exercise. Then we had one more thing that is called premium. Premium is always paid by buyer to seller to purchase the right or to have the choice whether to buy or not to buy. And then we have got exercise price. Exercise price and strike price remains the same, but exercise date is the final day of the contract in Indian terms. And what exactly is the term exercise? So as I said, that you pay the money, get the stock. So you are actually converting the contract into the stocks. That is called exercising the option. So this is how it goes. Now further, as I suggested, we would also be looking at in the money, at the money. And yes, because we're already up with more than 15 minutes in understanding just the option. So probably time value and intrinsic value would be clubbed in the next session along with the put option. But yes, let me take an opportunity to introduce moneyness of the option. Now, moneyness in the sense that there can be three such relationships. One is option is in the money. Another is at the money. And last is out of money, out of the money or out of money, whatever you write. Now, something very easy to understand. When you exercise the option and you have profit as an outcome, those options are known as in the money. So if when exercised, they give you positive cash flow. At the money, intuitively, nothing. So when you exercise, there is no profit, no loss, ignoring the premium because premium is to be set based on the moneyness of the option. And out of the money, if you exercise, it will give you negative cash flow. Now it is much more logical and intuitive that you are paying premium to the seller to get a right, then definitely you will never be exercising this one. So which options are actually exercised? So logically socho, when you're paying a price pay kar rahe ho, then definitely you will exercise when you are at profit. Otherwise, you will not exercise. So only in the money options are exercised. And what is in the money? Because they lead to positive cash flows. Now scenario in call option. So when market price is more than the strike price, when market price is more than strike price, so I can recollect that example when our strike price was 100 and say market price is 120, which is more than strike price 100, definitely it gives you positive cash flow of 20. So this is in the money. When market price is equal to strike price, this is better known as at the money, this will not be exercised. And out of money means when market price is less than the strike price, this can never be exercised. This is out of money and this will not be exercised. Right, so we've got a lot to learn with options. Right, so this session, we are concluding. This what we primarily understand about the call option. Next session, we would be learning put option, and then we'll try to complete. We'll do a couple of questions also without failure, so that you understand this concept really well. And then we'll start with some strategies. But yes, we had big agenda we couldn't complete today. Nonetheless, I'll make one more quick video which will cover what we have missed today. Meanwhile, try to understand this, and if you've got any doubt in this particular thing, you can definitely let me know. See you in the next session. Bye.